What's going on, apes? Welcome back to the channel. My name is Tyler. I'm glad you can join me on this afternoon for a very important video regarding hedge funds and institutions margin debt. We did just get the numbers for May and they are astonishing. We see the margin debt around the United States stock market go up yet again by about $15 billion. So this is definitely something we have to talk about, and the possibility of these shorts in AMC stock getting margin called and having these forced liquidations. Without any further ado, let's get into this video. Hit that like button for me and consider subscribing to the channel. Getting into it, first things first, just to touch on the price action we have been seeing, I do expect a strong consolidation phase in between $55 and $60 sometime in this next week or in the next couple of weeks. Now that is not a prediction, but I think it's safe to say we will retest this $55 and $60 resistance level that we do currently see, and then ultimately break out to the upside and witness the mother of all short squeezes. Now, to the important thing, let's take a look at the Finra margin debt. This is the margin debt for the United States stock market. For April 30th, 2021, we were at $847.19 billion. This is something you have heard many times if you watch these AMC videos, but for May, this jumped up to $861.63 billion for total margin debt. As far as 2008, we only had less than $50 billion in total margin debt. What is important to keep in mind here, because we do know a lot of shorts have short positions in AMC that we can see as far as the legal shorted shares, but there is a lot of illegally shorted shares, a lot of synthetic shares as well that are in the market, specifically with AMC stock. This does get really important when it does come down to an overall market sell-off. Once you do see that market sell-off, you're going to see this double-edged sword effect that I've been talking about, where shorts in AMC are going to be losing because AMC is likely to go up as the stock market goes down and to invert each other. So they will be losing on that side, as well as losing on their long positions that they are long on other stocks in. So I think that's the double-edged sword effect that will be probably most likely the biggest catalyst to send AMC straight to the moon. But why I am saying this and talking about this double-edged sword effect is quite simply the stock market overall has been propped up by stimulus and other activities the Fed has been doing for a very long time now. Since the pandemic did start, that was a year and a half ago. So odds are this is going to wind down and come to an end, and we are likely to see the economy actually start to slow down. We are seeing this being reflected in China, and China was the first to get rid of the pandemic. They were the first to recover. Now we are seeing them drop the RRR rate, which is the reserve requirement ratio. And what they're doing by this is sending a huge red flag that their economy is slowing down. They're also likely to cut interest rates at some point into the future, but also it is due to the fact that the Chinese economy is the second largest economy. America is obviously the first largest economy, and what tends to happen in China tends to happen in America. Now, the stock market is pricing in a lot of future growth and expectations. I'm not saying that won't happen. I'm not saying it will happen. I'm literally not saying anything about that, but just the fear and uncertainty and doubt around the thought of the economy slowing down will send the stock market down. And like I said, even on a technical basis and a fundamental basis, the stock market is seen as overbought. So this is only a matter of time. I'm not saying this to get you guys excited. This could happen tomorrow or even in the next couple of weeks. This could take a couple of months, but it is going to happen. And with all this free cash out in the marketplace, these shorts, everybody that does have margin debt, they're not covering their margin debt. They would rather stay in margin debt because the interest rates are so low, which I don't blame them. It's definitely not a bad strategy, but when you are on the verge of a potential market correction, the last thing you want is a lot of margin debt, like we are seeing with approaching $900 billion in margin debt. That is a huge amount, and a lot of this is due from hedge funds and institutions, a lot of shorting activity, as well as just overall buying stocks. But what happens when hedge funds and institutions, for the most part, don't want to cover their margin debt? They have to put up more cash to stay in their margin positions. We are seeing this being reflected in the overnight reverse repurchase agreements, or better known as reverse repo markets. And essentially what this is, just for those of you guys that don't know, it's when the banks either need more collateral or they have too much cash. Because as you guys know, and the best example of of this. If you deposit money into a savings account, they pay out interest. I don't even know what the interest rate is. My long-term investments are my savings account. That's essentially what I would use if a worst case scenario happened and I needed the money for something. But I believe they pay about 0.5% interest. Imagine if they have all this cash, they're not going to be able to make even 0.5% on this cash. They have to get rid of this and offload this to get these liabilities off their balance sheet. So that is what is happening here. They give the Fed this money, the Federal Reserve, the main banks of the banks. They give the Fed this money. They get treasury bonds in return. And this is only, like it says, an overnight reverse repurchase agreement. This can last, I believe, up to about 13 days, but this is a very fast thing. So it's usually overnight or within the span of a couple of days. Now, eventually the Fed is not going to accept all these reverse repos. They're going to say, you guys have to do something, get rid of this cash or stop accepting so many liabilities to your business. And that, I think, would be a huge factor when it does come to an overall market sell-off, because at that point, you would have no choice but to cover some of your margin debt. And considering we are at over double all-time highs we have seen in the reverse repo market going back throughout all of history, we are at double the highest point we have seen. This market did start in about 2012, but you've seen very little activity in the past. So this is a huge reflection of how much cash is in the system. And as you guys can see, this is a straight line up, and this does correlate with the precise moment that AMC did start to actually short squeeze and gamma squeeze last time around, and especially this time around, June 1st and June 2nd. We were only at about 400 billion in margin debt on June 1st. Now we were over double that and consolidating in between. Let's go back to the 1 year chart, consolidating in between about $800 billion as far as total margin debt. So this is very important to keep in mind. But we are also seeing the biggest red flag that you could ever see as far as too many people, hedge funds, institutions, and regular people alike are severely over leveraged. And that is Wells Fargo is shutting down its personal line of credit program. Why would they do this? They're going to lose customers. Is the risk to reward really worth it to lose customers over a potential risk that the market does go down and some people can't repay these loans? Obviously, Wells Fargo does think so. These loans are usually, or lines of credit, I should say, are usually in between $3,000 and $100,000. They were seen as a way to consolidate higher interest credit card debt and pay for some home renovations or avoid overdraft fees on linked checkings accounts. This is also a bit of a portfolio loan as well, because if you have $100,000 in your stock account, you could go get a loan, buy a car for $30,000, $50,000, whatever the case is. They will give you a loan on your portfolio. But if your portfolio is too risky and you're in way too risky stocks and assets, they're not going to give you the same amount of money. If you're in the S&P 500, you have $100,000, they might give you $50,000 straight cash as a line of credit to your portfolio. If you're in a lot of risky stocks, they're not going to give you nearly as much. They might give you $10,000. Now that is a stark example, but that is pretty much my interpretation of what is going on here. And this is a huge red flag, like I said, that the overall economy is getting very shaky right now. And Wells Fargo is seen as the riskiest bank out of the 4 biggest banks in the world, because Wells Fargo is one of the 4 biggest banks in the world. Now that is because they hold a lot of their loans on their balance sheet, car loans, home loans. Instead of selling them off to third parties, they actually keep a lot of these loans. So it's not a surprise that Wells Fargo is the first one that is shuttering these lines of credit. Like I said, huge red flag. You couldn't get a better red flag that something is severely wrong in the economy and the financial markets, more so in the financial markets. But this does kind of signal that they do think the economy will start to slow down a little bit, because obviously stock market and economy, they're not one and one, but they will eventually catch up to each other. So that is going to wrap up this video, guys. That is why the shorts and margin calls and forced recalls may be starting soon. With that being said, hit that like button for me. Consider subscribing to the channel for more AMC videos just like this, and to get all your economic data fixes, as well as if you guys want to get free stock, check out the link down below for public. There is a link, no deposit necessary, no need to even link your bank account. Takes about 3 minutes time and you get your free stock immediately. As well as if you guys are not signed up with Webull, deposit $100, get 4 free stocks, each of them potentially worth up to $2,400 a piece. And if you guys want to start winning on your trades as far as day trades, long-term investments, crypto, stocks, options. Doesn't matter what it is. We do everything in the buy and sell alerts. Check it out for yourself. It's very inexpensive and it pays for itself. But that is going to do it for this video. I will see you guys in the next one.